You jibber jab, bamboozle, nooka noozle, bippity bop, she called. You jibber jab, bamboozle, nooka noozle, bippity bop, she called. I mean, you keep on talking, but you don't know where to turn it off.
Welcome to the weekend. I'm John Caldera, president of the Independence Institute. You're watching Independent Thinking. So how's your bank doing? Is your money safe? If you're at all worried, just write a check to me and I'll keep care of it for you. To talk to us about it, Don Childers, who's from the Colorado Banking Association.
Bankers Association.
Yeah. Glad to have you here.
Thanks.
And also, you know him from the Denver Post. Al Lewis, thank you for being here. You're a columnist for Dow Jones. And more importantly, if you want to talk to Al, you just go to talktoal.com.
Tell it to Al.com.
Tell it to Al.
Thank you.
Tell it to Al.com, and then you get all the Al Lewis you want. All the records, all the albums, the movies, DVDs, everything you want. All right. Let's talk a little bit about the bank failures.
Okay.
Let's start here in Colorado and then maybe work our way out. There have been a fair amount of bankruptcies here in Colorado. We were talking before about one up in Greeley, which was not a small little mom and pop bank. It was a large one. Give me the details.
We've had 2 bank failures in Colorado this year, none for years prior to that. Nationally, we had 25 last year. We're about 30 right now. We'll end the year, we think, with 100 or so probably. But by historical perspective, that's actually very few. In 1990, the last year we were severely tested, we had 10 a week in this country.
That include the S&Ls?
No, those were commercial banks.
So we had 10 a week?
Yes, 534 and hundreds in the years before and after that. We made it through that, and we had actually half the capital in the banks that we have today. So there are a lot of meaningful distinctions from that last tough period.
Slow that down for a second, because that's interesting. Because there's this feeling now that banks are just destroying here and there and everywhere. They're going out of business. Here in Colorado, you say in the last year there's only been 2 banks that have gone under, which is of course too many. But historically, you're saying that's not that high.
I think the banks are in quite good shape. One of the issues we face is that the public tends to misuse the term bank. There's a precise definition. It's basically the institutions that can use the word bank in their name, and they're FDIC insured, which means they're subject to reams of government regulation and frequent examinations. But nobody knows how to refer to hedge funds, brokerage houses, pension plans, insurance companies, etc., which are all in the lending business and financial services, and so they use the shorthand bank. The general public then, when they read something about a brokerage house in trouble, it gets reported as bank, such as I've watched the headlines since last September. The bank bailout headlines almost never refer to a bank.
Well, let me tell you what happens, though. The distinctions between what is a bank, what is an insurance company, what is an investment bank have been blurred since 1999 when we got rid of Glass-Steagall, which basically allowed banks to go into investment banking, allowed investment banks to go into banking, allowed everybody to sell insurance products. So the distinction bank is a pretty broad term because of that. Secondarily, investment banks on Wall Street, which all got bailouts, which in some form or another, it began with Bear Stearns. Merrill Lynch was sold to Bank of America. There's another company with bank in its name. But what I'm trying to say is all these investment banks became banks. And so when you talk about a failing bank, broadly, a lot of financial institutions are generically called banks. IndyMac, which failed, some call it a bank, some call it a savings and loan.
But bringing it here to Colorado, up in Greeley, it was New Frontier. Now, this was no small mom and pop bank.
It was a $1 billion
Actually,
bank.
2.
Was it 2?
$2 billion bank. Why did it go under?
I think poor loan underwriting, and I'm not here to beat up on the bankers who work there. But
you mean they gave loans to guys like me?
Well, to folks who weren't qualified, there seemed to be a portfolio full of those. I know they made a lot of good loans, and that there are a lot of customers that are now inconvenienced at the least because they're having difficulty getting credit elsewhere. But the bank simply grew very rapidly. It's hard to go through that kind of a growth to $2 billion in 10 years.
Let me see if I understand how this works. So if I start off a bank, a real bank, all right, I fill out all the forms, I do all the paperwork, and I want to attract a lot of money in, I might be able to give questionable guys money in loans. They get used to it. I give my depositors a little extra an interest rate on their investments, so it's easier for me to build up. But doesn't the government say that I can't give money to risky guys like Al Lewis?
to a
I'm actually
degree.
at great credit risk.
I've never lent to you.
I've never had a bank fail on me.
When the institution is being examined by the bank regulators, they tend to leave them relatively untouched if they're in good condition. And there are a lot of things that are tested, about 23 major areas that the examiners review. But if they start seeing red flags go up, the regulators have the ability and freely exercise it to control what that bank can do. And that's in the interests of protecting the safety and soundness of that institution and the whole system.
When a bank, and I do mean bank, goes under, it has a huge ripple effect. Take New Frontiers Bank, so it had $2 billion worth of assets, and up in Greeley, lots of farmers, lots of ag companies, a lot of businesses use that company for their line of credit to make sure that they could pay their bills and do their business. And once that bank is closed, and if they can't get quickly into another bank, then these businesses could fold. Why? You tell me, why did a sizable bank like
any bank that fails because of bad loan quality, almost invariably. There's a lot of banks on Wall Street that fail because they bought portfolios of debt, right, that contain subprime debt. But again, this is bad loan quality. The distinction that I think Don wants to make is that the big banks of our world, and I'm talking money center banks like Citigroup and Bank of America, I'm talking about Merrill Lynch's, I'm talking about investment banks, I'm talking broadly about the giants. They're all interconnected, and they're also interconnected, by the way, with community banks too. But they all made bad bets on portfolios of debt that is all going bad right now. We don't know the depths of it. I mean, we recently put 19 of these big banks through stress tests. Some of them came out okay.
You say stress test?
Well, what they did was they assumed certain financial conditions. They applied them to the balance sheets of the books,
right.
And then this is what that would do. It's all very
So
theoretical.
in other words, if the economy got this bad, we think these businesses will go under.
Sure.
Would you be able to survive that as a bank?
Right,
Yes.
and the result of this is several banks are okay. About a half a dozen banks so far have been told they need to get more capital, and then the jury is still out on a few others. The information hasn't been fully leaked yet. But what I'm saying is that these big these big money center banks, first of all, they're all to some extent Ponzi schemes. You look at Citigroup, you look at Bank of America, what do? They grow, right, by mergers and acquisitions. Every year they do another merger and acquisition until they finally get to the point where the economy turns. And guess what? It looks like they overpaid grossly for all these mergers and acquisitions. All these executives and boards of directors stuff in their pockets.
You can't call that a Ponzi scheme.
Well, I can if I want to.
Well, you can.
Basically, what they're doing
with
is
credibility.
Excuse me. What they have done is unsustainable. A Ponzi scheme is also unsustainable. What they have done is merger after merger, deal after deal.
What they did was legal. It was bad decisions.
Well, there's the difference, I guess. But we'll see how legal it was before it's all over. But here's the thing. Not only are they doing mergers and acquisitions, but they're building enormous portfolios of junk debt. Junk. I mean, this stuff, no one knows what it's worth. And frankly, we haven't gotten to the bottom of it yet. Even with these stress tests, I'm not convinced that all these big banks don't need more government money to build them out.
But I think you're overstating things. You say they're portfolios full of junk debt. Have you seen them? Do you know what's in there? No, but I know the government examiners have, and they've got pretty good credentials for doing this stuff.
The government examiners who predicted this whole thing, are those the ones that you're talking about?
Let's back
the
this
ones
up.
who said,
Whoa,
the banking system's getting risky. They never thought it was risky until Bear Stearns blew up.
Let's bring it to the little guy.
Okay.
All right. I got my $350 in my savings account in a bank. Is it safe? Let me ask you that. If it is in what you consider to be what is technically a bank, not in my Ameritrade account, but I'm talking a bank.
It's absolutely safe in two regards. One, banking in general is very well capitalized, despite what Al says. 97% of the banks.
Funds.
97% of the banks are in the highest government rating, well capitalized. Secondly, the depositor is protected by FDIC insurance up to $250,000 per account category. And so depositors, assuming they have on deposit less than that amount, simply don't need to worry. The system is designed to protect them. It works well. That doesn't mean there's never a bank failure, but it means the depositors are protected when there is a bank failure.